Good afternoon, everyone. I, CS Rita Singhal, on behalf of ICSI, welcome you all to the session of EEE 2.0 webinar series. The Institute launched this EEE 2.0 bi-weekly series in the month of June 2021 an attempt to keep the governance professionals abreast with the dynamics of Companies Act 2013 and SEBI laws. Till that, 26 sessions have already been held covering major topics of Companies Act 2013 and SEBI laws. Recording of live webinars are also available for viewing. Before starting the session, I wish to give a brief about the ICSI National Awards for Excellence in Corporate Governance. The Institute of Company Secretaries of India is committed to promoting good corporate governance and has played a pivotal role in creating awareness about the same. Let's have a look at the video.
The Institute of Company Secretaries of India invites nomination for the ICSI National Awards for Excellence in Corporate Governance 2021. The ICSI National Awards are one of the most prestigious awards in the country that recognizes and promotes the culture of good corporate governance.
This year, the Institute rolls out the 21st edition of the ICSI National Awards for Excellence in Corporate Governance.
6th ICSI CSR Excellence Awards, 3rd ICSI Best Secretarial Audit Report Award and 1st ICSI Best PCS Firm Award.
Applications for nominations open. Apply now. Last date of application 6th October 2021.
I urge all the members to fill the nomination for the date for nomination is approaching soon. Coming back to the topic for today's session is reduction of share capital. The reduction of share capital is a delicate matter for both managerially and legally. It needs to be handled with caution. So another name of reduction of share capital is internal reconstruction, and we have with us CS Atul Mittal to take us through the topic for the day. CS Atul Mittal is a law graduate, fellow member of Institute of Company Secretaries of India and qualified Institute of Chartered Secretaries and Administrators, London. He has about 24 plus years of post-qualification experience in matter relating to corporate and commercial laws. He has worked with top business houses of India like Birlas, Heroes, Religare for a decade. His last employment was with PricewaterhouseCoopers Private Limited for around 5 years. He has significant diverse experience of private equity, drafting and weighting of shareholders, foreign collaboration and joint venture agreements, JV negotiation, corporate restructuring, merger, acquisition, takeover, due diligence, deal advisory, SEBI and capital market, employment and industrial laws, competition laws, etc. He is a senior faculty and regular speaker to seminars and conferences conducted by various management institutes, law colleges, Institute of Chartered Accountants of India, Institute of Company Secretaries of India, Indian Chamber of Commerce, like FICCI, CIE, ASSOCHAM, PSDCCI, and foreign embassies. He was a member on the Expert Advisory Committee of Ministry of Corporate Affairs on LLP and Takeover Code. He was chairman of National for Corporate Fraud and Internal Audit of ASSOCHAM for the year 2013 and 14. He has been the chairman of NIRC of ICSI in 2009 and has been Central Council member of Institute of Company Secretaries of India from 2011 to 2014. Presently, he is working as Pilot Director with Deloitte Haskins and Sells. Welcome, sir, and over to you, sir.
Thank you very much. Good afternoon to all the participants. The responsibility which has been casted on me by our institute to share my views and thoughts on capital reduction and buyback. The session would include certain key provision from the perspective of Companies Act with respect to capital reduction. Process need to be followed for a listed company, unlisted company, and also to share with you the provision relating to buyback of share for a listed and unlisted company, comparison of both, and finally certain foreign exchange regulation when the foreign investor is been there into the company, and what are the other area we need to keep in mind while we are undergoing for a internal capital restructuring by way of capital reduction or a buyback, and followed by 3 or 4 case laws. With this, I am starting my presentation, friends. If we see what exactly that capital reduction is, reduction of share capital, of the paid up share capital of the company, we need to keep in mind why it is required. It is one of the manner and method of capital reorganization, reconstruction of the capital per se, with an objective to achieve overall efficiencies within the capital structure of the organization as a whole, which would be beneficial to all the stakeholders given the certain circumstances and scenarios we have in mind while carrying out the process of capital restructure or capital reorganization per se. Friends, when we see why there is a need of reduction of share capital, as an introduction, the need for reduction of share capital is generally keeping in with the overall corporate restructuring. This is one of the tools for corporate restructuring. As you would have attended my previous seminars also, conferences also, it is one of the effective tool for reduction of share capital. It is a manner and method which is being provided under the provision of Companies Act. If I see capital reduction in company law is been directly or indirectly covered in 3 areas. One in section 66, another in section 68, another by way of section 232, where scheme of compromise or arrangement is being envisaged from the perspective of providing certain benefit to the shareholders or the members of the company, which sometimes include reorganization of the capital, restructuring of the capital, including the reduction of share capital. When we talk about why generally there is a need of reduction of share capital, it is mainly from the perspective of accumulated business losses, asset of reduced or doubtful value, etc. And as a result, original capital may either become lost or a company may find that it has more resources that it can profitably employ. In either of these cases, need may arise to reduce the share capital of the company. Fundamentally, if we see the restructuring purpose or the restructuring by way of capital reduction is been envisaged by number of ways and mean. If we see the overall legislative framework, particularly for the purpose of capital reduction, is been governed by section 66, erstwhile section 66 of the new Companies Act, that is Companies Act 2013, and 66 also have rules which has been notified from the December 15, 2016. Reduction may be achieved through a scheme of arrangement, compromise arrangement, as I discussed under section 232 and 231. Friends, if we see the legislative framework from the perspective of capital restructuring or by capital reduction is to be achieved in a different manner with a different objective. Sometimes it may be possible for you, it may be required for you you want to get rid of a particular set of shareholders. Sometimes it may be possible you have allotted the capital, but because of the legislative compulsion, you may need to go for a capital reduction. Sometimes it may be possible for you want to overall reward the shareholders of the company by way of having an excessive cash. Therefore, if we see the new law, section 66 of the new act and the erstwhile section 100 of the Companies Act, if you recall our old golden days when we used to talk about reorganization of capital dealt by section 94 and reduction of share capital reduction or the reduction of share capital has been envisaged through section 100. Now the section has been replaced with section 61, which is talking about reorganization of the capital, whereas section 66 is talking about the reduction of the share capital. The fundamental difference between the section 66 is talking about and 61 is talking about enabling provision, whereas 66 is talking about a reduction of the paid up share capital of the company. If capital has already been paid up, someone has already become the shareholder of the company, and that too only and only in a scenario of an equity share capital of the company. Therefore, if you see in the subsequent slide, you will realize and will find redemption of the preference share is never been considered as a reduction of share capital. It is a clear-cut exemption provided in Section 55, but from the perspective of capital reduction, it is only Section 66, where we are reducing the share capital of the company by way of adjusting the value or per value of the share or the fair value of the share, per value of the share, etc. If we see the new section which has been imposed, which has been provided under the Companies Act 2013, that will give you a different kind of feeler. It is talking about that reduction of share capital can be achieved in any manner and in particular. It is an exhaustive, it is not an inclusive, it is exhaustive and inclusive both. Wide range of variety has been provided, whatever the manner of it, and more particularly it can be achieved by way of extinguish or reduce the liability on any of its shares in respect of the share capital not paid on. If some call-in area is there, cancel that out. You convert this into the fully paid up, chapter is over. Another situation and scenario could be either with or without extinguish or reducing the liability of any of its share, as we envisage in the aforesaid clause, by way of cancellation of any paid up share capital which is lost or is unrepresented the available asset, or pay off any paid up share capital which is in excess of want of the company. First is talking about when you're reducing the share capital, like assuming the value of the share, the face value of the share is 100, you are reducing to the face value of 10. 90 has been adjusted and accordingly done. Sometimes it may be possible that company is having a huge cash available to you. Rather than paying as a dividend, you would like to take it as a distributing to the shareholders of the company. Distributing to the shareholder of the company, as long as the percentage of the voting right is not getting exhausted, manner and method can be achieved by way of giving excessive cash in the system. That is why we say paying off any paid up share capital which is in excess of the want of the company. The only and only requirement under this is you have to have the sufficient cash to share with the employees or shares of the shareholders of the company. And of course, purchase of shares of any member under direction of NCLT. Apart from that, there are circumstances provided under Operation and Management section under Section 242B, 2B and 2C, which is talking about a company by the order of the NCLT, when there is a situation of a capital, when there is a situation, the working of the company is not acting in the public interest or in the which is prejudicial to the public interest, then while you are approaching to the NCLT under the situation or circumstances of an operation and mismanagement, you can proceed. You can approach to the NCLT, and NCLT can make a necessary order, including but not limited to under subsection 2. There are 6 circumstances which has been provided. One of the provision by way of adjustment of the capital is purchase of shares of any member under direction of the NCLT. In this scenario, it is under the obligation provided and imposed by the NCLT on the company. You are purchasing the share. That purchasing of shares, then you are cancelling the paid up capital and adjusting, that would also be treated as a reduction of share capital. But instead of Section 66, it shall be considered reduction of share capital under Section 242B and C. If you see, it is an inclusive list as indicated by the word any man in any manner, and in particular, which gives freedom to the company to adopt any mode of reducing capital. The word in any manner, friends, gives a wider, as we discussed, wider meaning, and there is no limit on the mode in which the capital can be reduced. This is what the overall gist of the Section 66 manner, method, legislative requirement, why we are requiring that, why there is a requirement of a capital reduction. It may be possible, friends, some set of shareholder you want to get rid of. You can go for a capital reduction. The manner and the purpose is being further detailed in the subsequent slide, that is, extinguish or reduce the resources liability on partly paid up shares paid by back them, eliminating the losses which may be preventing the payment of the dividend. Friends, if you see under the provision of for dividend payment, they are saying even if you are having a accumulated profit, because now mandatory transfer to general reserve has been done away. You have an accumulated profit either through the reserves or cash balance into the profit and loss account. You can pay the dividend, but there is an embargo. In case there is any loss, first you need to adjust the loss and depreciation. Assuming you have a super profit of say 100 crores, your paying capacity as a dividend, of course, is been there, but accumulated losses into the financial statement of the company is there, say to the tune of 200 crores. meaning thereby that particular thing obstruct you to pay the dividend. Despite you have the available cash, despite you have the current year profit, but the previous losses are not leaving you behind. You are unnecessarily stuck because of this, and you will not be able to pay the dividend. The manner and method and the decision should be: first, you go and get the settle the paid up capital losses with the paid up capital of the company or net worth with the company. Once it has been done, then immediately after that your net worth will become positive. That means the loans are no longer existing, and accordingly you can, going forward, you can pay the dividend. Another way of achieving or another purpose of capital reduction could be by way of part of scheme of compromise or arrangement to optimize capital structure of the restructured or merged entity. Another could be simplification of the capital structure, returning of the surplus to the shareholders of the company, assuming the company is having a huge cash available with them. 100 crores, 200 crores, 500 crores are lying over there. But the fundamental is dividend distribution is difficult because of any reason. Then you are approaching to the NCLT by way of a scheme formed for the purpose of returning the excessive cash, as we discussed in the previous slide. You can approach it and accordingly get the order and pay the excessive cash to the shareholders of the company. Another purpose could be swap shares for debentures or some other security instrument. Another could be bringing the amount of its issued capital in line with the value of its net asset in case of accumulated losses. As we discussed, your paid up capital is of say 100 crores. Losses are there for 80 crores. Effectively, your net worth has been showing 20 crores. Why you are unnecessarily carrying out the baggage of having a legacy losses, etc. Go to the capital reduction scheme, file and re-engineering the financial status of the company, adjust the losses with the paid up capital of the company. As long as the percentage voting right remains to the shareholders same, should not have any problem. Authorities are giving you the approval, NCLT sanction the scheme, chapter over, balance sheet is clean, and future inability to show the company profitable has been there. Friends, if we see, there are the example which we have discussed in the previous slide pertains to what shall tantamount as a capital reduction. But what shall not tantamount as a capital reduction is diminution of the capital by cancellation of the unsubscribed part of the issued capital. You have called for but not paid off. That is not a capital reduction. Redemption of the redeemable preference shares. That is not, because there is a clear cut reference in the section 55. Any redemption of preference shares under section 55 shall not be treated as a capital reduction. Buyback of shares, because the buyback of shares has been separately dealt. There is a separate section provided under the Act now, 66 of section now 77 capital A of the previous Act. Buyback is also akin to capital reduction, but in a limited way, in a limited manner. Not the circumstances as detailed out as vast tension which is provided in the section 66, where the 68 pertains to buyback is having a altogether different ballpark. We are going to discuss this difference between buyback of share or capital reduction in the ensuing slides. Another way which would not be treated as a reduction share of capital is the reduction of nominal capital of the company by cancelling any of the share which have not been taken or agreed to be taken by a person. Last but not the least, forfeiture of shares. In all these five circumstances shall not be considered, shall not tantamount as a capital reduction, and separate sections are dealing with section 61, section 66, section 61, section 65, section 68 are dealing with this provision and talking about these five circumstances will not tantamount as a capital reduction. Friends, if we talk about provision on capital reduction, though it looks good that capital reduction is possible, but there are two stumbling points. In case you have any arrear of repayment of deposit or any interest thereon, then you cannot proceed for. If in either of this situation, either you have an arrear for repayment of deposit, no reduction of share capital shall be made if the company is in arrear of any repayment. If any interest is due, again you will not be in a position to resort capital reduction. Therefore, you have to be mindful before resorting any such kind of capital reduction process. You should see whether your rules, by reading the law, by reading the rules, whether it enables you to proceed for the capital reduction or not. These are the two things we have to keep in mind. Of course, if you talk about the mandatory requirement for the proposed share capital in terms of the provisions of the companies that you have to convene the board meeting for reduction of the share capital. Thereafter, you need to go for a claim of creditor, debt or claim for every creditor of the company has been discharged and determined or has been secured or his consent has been obtained. Thereafter, you have to hold the shareholder meeting and passing the required resolution for reduction of share capital. Passing of resolution is to be carried out. And finally, now the new Companies Act 2013, which has clearly stated accounting treatment, confirmation and certificate is mandatory from the auditor of the company. Therefore, they made it mandatory. No application for reduction of share capital shall be sanctioned by the tribunal unless the accounting treatment proposed by the company for such reduction is in conformity with the accounting standards specified in section 133 or any other provision of this act, and certificate to that effect is been issued by a statutory auditor of the company. Statutory auditor with the and has to be filed with the agreement. Just like your section scheme of merger amalgamation, accounting treatment effect is mandatory. Therefore, it is essential for us to understand all these 4 steps. Once we have taken this 4 steps, what is next? In addition to that, additional compliances need to be carried out by listed company. Regulation 11 is talking about scheme of arrangement. It is a very, very wide section which include all kind of restructuring or arrangement is taking place. This include merger, amalgamation, any kind of restructuring, merger, amalgamation, restructuring, scheme of compromise, arrangement, including buyback or capital reduction. Another thing you have to keep in mind, friends, whenever we are going for a capital restructuring scheme by way of scheme of compromise arrangement, earlier we used to take the benefit of section 68, which was section 77A, which was talking about a buyback of share. What we were doing, what we were allowed, first we go for a buyback of share to the extent of 25%. I'm sure all of you are aware. And at second stage, immediately after buyback, there was no restriction to go for a capital reduction and go and take out the money or do whatever you want to do for the purpose of reduction of share capital of the company by passing on the cash to the shareholders of the company. Now, 2013 Act clearly states that in case you are going for a scheme of capital reduction through scheme of capital compromise and arrangement, definitely the provision of section 68, that is buyback of share, need to be necessarily followed on. What are those conditions which we'll discuss in detail while we are taking or while we are discussing section 68 with respect to buyback of shares. Compliances need to be taken. If you see the regulation 11, it talk about the listed entity shall ensure that any scheme of arrangement or amalgamation, merger, reconstruction, reduction of capital to be present to any court or tribunal does not in any way violate, override or limit the provision of security law requirement of the stock exchange. Compliance is intimation to the stock exchange about the meeting, fixation of the record date and intimating thereof, filing of scheme with the stock exchange SEBI, taking their consent through SEBI and NOC and observation letter. Friends, please keep in mind, please keep in mind this process for the listed company is essential before resorting capital reduction, before filing the scheme to the NCLT, Honorable Bench of the NCLT of the jurisdictional judicature. You have to keep in mind it is essential for you to go and seek a specific file and application for under regulation for approving it by the SEBI. So there are one case law is there, very leading case law, which I'm going to cover at the end of the session. What basically transpired by the authorities for the purpose of following up this rule, and accordingly they have vitiated the capital reduction process and thrown the scheme out of the window because the process has not been followed when stock exchange SEBI has heavily objected to that scheme. I'll share with you now it is in a public domain from last 5 years. I'll discuss and we'll try to explain you the nuances of that scheme so that you should be able to understand the significance of these kind of things. You have to keep in mind, friends, even if assuming you have proceeded, NOC has not been received, you have filed a petition to the NCLT and incidentally or luckily NCLT has also approved the scheme. Even if the scheme has been approved for capital reduction, that cannot be made binding if stock exchange or the SEBI has not approved it, and if SEBI and stock exchange want to, SEBI or stock exchange want to object, they can object under the SEBI regulation. Please, you have to keep in mind, whenever order has been made under section 66 by the Honorable Bench of the NCLT, there is an order only and only under the provision of 66. Therefore, whatever the add-on approval is to be required, that is to be required in addition to the section 66 order. You cannot compel You cannot take it as an argument or the statement, or I would say argument or submission before the any other authority like Competition Commission of India or your stock exchange or SEBI, etc. Hey, look, guys, since I have the NCLT order, therefore you are bound to follow this, and you are bound to follow. Then you have no reason and no power to object it. They have the power. That those powers are coming from the SCRA Act, Security Control and Regulation Act, and the SEBI or the respective legislation. Therefore, you have to be mindful whenever these kind of things are being envisaged. All the approval required for the purpose is required to be sought to be obtained from the respective agency. Not only from the corporate law or the FEMA or I would say SEBI regulation. Sometimes it may be possible you have entered into a shareholder agreement with the respective agencies. Assuming some regulations are there, some entrenched provisions are there in your joint venture or share purchase or shareholder agreement, or some government agency where you are working, like infrastructure project company or some bank, financial institution, etc. Those kind of funding and those kind of commercial and business arrangement always say any kind of capital reorganization, capital restructuring change, merger amalgamation that require our prior approval. Therefore, whenever you are envisaging those kind of things, you have to keep in mind whether the approval or the process for seeking approval or permission of all the stakeholders, whosoever is required, has been obtained or not. And the process of capital reduction generally starts from the alteration of article of association, if required, passing a special resolution. What are the content and information that we have discussed in the just for reference point in the subsequent slide. Filing of application with the NCLT in form RSC1. NCLT to issue notice or direct company to issue notice within 15 days of the submission of the application to the regulatory authorities and creditors seeking their representation and objection, if any. However, the dispensation of the notice can be provided with NCLT. NCLT may dispense of the requirement of that giving notice to the creditor publication of notice where it is certified that debt or claim of every creditor of the company has been discharged or determined or has been secured or creditor consent has been obtained. Then dispensation of the meeting for holding the creditor meeting can be taken care of. Dispensation not granted, then where the dispensation of the NCLT is not granted, NCLT shall issue direction to the company for seeking objection from the creditor and intimating about the date of hearing. Finally, you need to file the affidavit, company or a person directed to issue notice and publication in newspaper to file affidavit confirming dispatch and publication of the notice in form RSC 5 with the NCLT within 7 days of issue of notice. The representation by central government, ROC or other government statutory agencies is open for 3-month period of time. Therefore, regulatory authority to send representation to the NCLT within 3 months from the date of receipt of notice, and copy of the representation shall be sent to the company. If no representation has been received, friends, within the said period, it shall be presumed that they have no objection and NCLT will proceed accordingly. If receipt of representation is there, then in case of representation received, then company shall submit a response to the NCLT within 7 days of expiry of the order up to which representation or objection has been sought. And NCLT may give necessary direction as may think fit with respect to any inquiry or adjudication claim or hearing of the objection or otherwise. Once it has been settled, NCLT order has been issued in form RSC, company to file this order to the ROC, and certificate to be issued by ROC in form RSC 7, and memorandum of article of association of the company need to be amended accordingly. Friends, this is the overall process we need to see. Capital reduction, adjustment, extinguishment, wiping of the losses of the company. Now, thanks to the new Companies Act, BIFR provisions are not there. Most of the company, net worth of the company has been generally been eroded on account of losses, continuous losses. And the way out was always been adjust the losses against the paid-up capital of the company, if at all it is possible, and thereby come out of the purview of the BIFR potential sickness or sickness. Now those regulations are not existing, but still in the previous cases, in the previous carry forward cases are there, still you need to bind yourself with those rules and regulations. The way and manner of the capital reductions can be achieved in a different manner. There are very large canvas which has been provided, long canvas which has been provided where you can brush your paint and accordingly take it forward. If you see the notes, article of association, we talk about the explanation statement. Article of association of the company should contain enabling provision for capital reduction. And along with the RSC1, the following document need to be submitted from as a matter of process. List of creditors should not be more than 50 days prior. Certified by the company, managing director and two directors. Certified by the auditor as we discussed. Indicating the name of the creditor, amount payable to them, or creditor consent letter if available. Certificate confirming that company not being in arrear of any deposit and interest thereon, to be certified by the director and certified by the auditor and accordingly filed. Certificate stating that the accounting treatment proposed in conformity with section 133 confirmed by the auditor of the company. And notice to the creditor state the following: amount of the proposed share capital, amount of the estimate value of the debt or contingent liability, contingent debt. Advertisement should be published in an English newspaper, in a leading newspaper and a leading vernacular language, both having wide circulation. The company shall deliver a certified copy of the order and minute approved by the NCLT showing the following: amount of share capital. This is point number 5 is at the end. Once everything is done and dusted, filing and reporting to registrar of company, following document need to be submitted: amount of share capital, number of share into which it is divided, number of each shares and amount if any, the date of registration of the deemed paid up share capital. Friends, if we see the total time frame, the broad process, planning part, preparation of draft petition, identification of the creditor, obtaining of the statutory auditor certificate and approval by the board, calling of general meeting for approval of the scheme and consider the objection or suggestion received by the company, file application of petition with the NCLT for reduction of capital, notice to the registrar of company, regional directorate and creditor and person affected by the scheme, publication of notice within 7 days of NCLT direction in English newspaper and vernacular language, filing of the affidavit with NCLT within 7 days confirming dispatch of notice, representation by ROC RD and creditor within 90 days of the date of the receipt of notice, filing of representation of objection with NCLT, NCLT issue order sanction of reduction of capital and filing of NCLT order with ROC, filing of form with AD Bank for capital reduction if foreign investor is existing into the system, and ROC shall issue certificate confirming capital reduction. Friends, practically we have seen this generally take, barring pandemic or COVID situation, generally takes 7 to 9 month period of time. Considering the scheme of compromise and arrangement and other merger and amalgamation scenario, where those cases can be still expedited much faster, if at all this is possible. But from the capital reduction perspective, the minimum 3 month notice period is required, is been given to the regulatory agency. Rather than in general, we have seen for the merger scenario, merger amalgamation or demerger cases or scheme of compromise arrangement, the objection period or I would say the observation period to this regulatory agency has been provided for 30 days. Whereas now for capital reduction, the time period is little longer, or I would say substantial, is 90 days for the purpose of giving representation to the authority. This is the maximum. This is the additional 3 month or 2 month time, I would say. Exactly, it is 2 month time which has been required. Otherwise, this can be achieved if NCLT bench are meeting and hearing the matter. Overall time frame 7 to 9 months is on a conservative, on a most aggressive side, I would say. Practically, I would say we have seen the cases where the matters are pending from last year or so. Now, this was all about capital reduction. Now, let's see some part of the buyback of shares. Buyback of shares, friends, is been dealt by, I'm sure all of you are aware, Section 68 and 72. It came into effect from 1st April 2014. Section 69 and 70 came into effect from September 12, 2013. And companies' share capital and debenture rules came into effect from 1st of April 2014. Buyback of securities, friends, key highlights, sources of buyback could be out of the free reserves, share premium account, proceeds of the issue of any shares or other specified securities, and no buyback shall be allowed out of the proceeds of earlier issue of same kind of shares or security. That means buyback cannot be resorted from the proceeds of the buyback for equity share cannot be resorted out of the proceeds of the fresh issue of equity share. It can be by the fresh issue of the preference share, or if you intend to redeem, if we need to buy back the preference share, then it can be redeemed out of the proceeds of the equity share. Vice versa can possible, but not with the same kind of same issue. Because what is the very objective in case you want to replace this with the another equity shareholder? It could be another from the preference to equity or equity to preference. Friends, you have to keep in mind pre-reserve share premium these three things are mutually exclusive. Pre-reserve, share premium, and proceeds of issues of any other kind. These are three mutually exclusive provisions, sometimes free. Therefore, you have to keep in mind, generally what we do, we issue the shares at a heavy premium, utilize the share premium for the purpose of buyback, for giving partial exit. Because a buyback is always a restrictive buyback because of the condition posed, which we are going to discuss in the subsequent slides. Option for buyback from the existing shareholder or security holder on proportionate basis. For a listed company from the open market or by purchasing of security issued to the employees, companies through sweat equity, ESOP scheme or ESPS scheme, etc. If you talk about the prerequisite for buyback, it should have authorization in its article. Shareholder resolution need to be passed. Only board resolution to be passed in case you propose to buyback for 10%. If you are going for a more than 25%, shareholder approval is required. Debt to paid up equity capital and free reserve to be 2:1. This is the mandatory requirement. Shares or special securities are to be fully paid up, and buyback of the listed shares or listed securities, specified security to be done in accordance with the SEBI regulation. No buyback offer shall be made within a period of 1 year from the date of closure of the preceding offer. You have to keep in mind, friends, this is the major obstacle for all of us. In case you have done one buyback, earlier this 1 year window was not there. It was only at the financial year. What we used to do, first buyback we were covering, say, February or April or January or December, say in February or March even. Another buyback because March closing, if the money March closing is the close of the financial year, and another is buyback we were resorting in the next year, say April or May. That means within a period of 2 months, two buybacks were possible. But now they clearly say the gap between previous and the new buyback should be minimum of 1 year. You have to keep in mind while you are planning for the buyback. Another condition, those are we have to keep in mind restriction on buyback. No buyback of shares of specified security is allowed directly or indirectly through subsidiary, to any subsidiary company, including its own subsidiary company, to any investment company or a group company. If you have defaulted in deposit, no buyback is possible. Where the company is defaulting the repayment of a deposit or interest thereon, redemption of debenture or preference shares or payment of dividend, repayment of any term loan or interest payable thereon to any financial institution, banking company, and 3 years has not been elapsed. In that scenario, if it is well within the 3 year period, then you cannot do. After expiry of 3, you can do, else not. But the company is non-compliant with the section 2 with respect to filing of annual return, etc. Under these 4 circumstances, I would say these are the restriction where in case you are having either of these kind of situation and scenario, then restriction on buyback is there. You can't resort buyback. If you talk about the key highlights which has been provided, which earlier was not there in the 77A, which has been provided in section 668, explanatory statement should be attached. Time limit for buyback should be 1 year. Letter of offer and solvency of declaration is to be given. Extinguishment of the certificate should take place within 7 days of the last completion of. Friends, this is the most important point for the restructuring of the overall strategy. No further issue for next 6 month period of time. It may be possible you would like to enter into an arrangement where the new investor is coming to make investment into equity. Existing shareholder would like sufficient cash has been there. They want to take it out by way of resorting buyback. The moment that you go for an equity buyback and you intend to have another round of equity infusion by any other person or the shareholder, any other person, third party or the existing shareholder, there has to be a minimum lock-in or cooling off period of 6 months. Therefore, it says company shall not make any further issue of same kind of shares or other security, including allotment of new shares or other specific security within a period of 6 months. However, 2 exceptions have been there: bonus issue or in discharge of the subsisting obligations such as conversion of warrant, stock option scheme to equity or conversion of preference share or debenture into equity. means the obligation which has already been existence. Like warrant we have already given. Stock option, sweat equity, etc. has been the part of the ESOP or employee benefit scheme or conversion of preference already. They're saying subsisting obligation. You have to keep in mind we are talking about any subsisting obligation is there which is before resorting of buyback, then you can proceed, otherwise not. Bonus is of course is an exception because of the reason it's nothing, only no cash in cash out is taking place. You're just replacing that one column to another column, and register to be maintained in SH10. If we talk about other highlight, return of the buyback and declaration need to file within 30 days. Obligation of the company from the listed company to provide all these kind of things, and capital reduction reserve need to be created in case of buyback out of the free reserve or share premium. Only in these two scenarios, a sum equal to the nominal value of the shares of purchase shall be transferred to the CRR account, and the details shall be disclosed in the financial statement. CRR account may be applied by company in paying of the unissued shares of the company to be member of the company as fully paid up bonus shares. Friends, if we talk about the overall process flow, of course, as usual, convening of the board meeting to pass the resolution for the buyback, subject to shareholder approval. Coordinate with the bank for opening of the bank account for buyback of share to be opened before closure of the offer. Send notice of the extra general meeting at least 21 days clear. Convening and holding of extra general meeting to pass the special resolution, and following document to be filed with ROC, MGT4, GNL2 and letter of offer, which is to be proposed immediately to be sent to the shareholder. Dispatch of the letter of offer to buyback to all the shareholders immediately after filing the same to ROC, but not later than 20 days from filing. Closure of offer. Deposit of the entire amount due and payable as a consideration equal to the consideration to be payable to the shares proposed to be bought back in the separate bank account. Complete the verification of the offer received by cutoff date within 15 days of the closure offer. Friend, you need to mandatorily keep the offer open for 15 days, though there are certain people who are taking a view, certain organization take a view. If our buyback is completed in next day, say all the offer has been, or the shareholder has exercised right very next day or first day, we can reduce this timeline. In our view, it's not possible, but still views are views until the authorities come clearly for that. If any offer has been rejected, send letter of rejection within 21 days of the closure for detailing out the reason. Make payment to those shareholders whose offer have been accepted within 7 days of the verification of the offer. Extinguish and physically destroy the share certificates so bought out within 7 days of the last date of the completion of buyback. File to the registrar, that is register of company, return in form SH11 within 30 days of the such completion, along with the certificate in SH15 signed by 2 directors of the company, including managing director, if any, certifying that buyback of shares securities has been made in compliance with the provisions of the Act and the rules made there. If I see additional compliance is for late state company, they need to have a buyback through tender offer. If they, in case they are going to tender of 15% of the number of security which the company proposed to buy back, number of security, declaration of result by postal ballot, filing of draft to SEBI, and offer to be shall remain open for 10 days as against 15 days in a unlisted company. Free reserve, friends, they have defined differently. They are talking about free reserve to include reserve which, as per the latest audited balance sheet of the company, are available to distribution as a dividend, provided that any amount representing unrealized gain, notional gain, or revaluation asset shall be excluded, and any change in the carrying out of the asset need to be excluded, but shall not be treated as a free reserve. However, Section 68, if we talk about, that talks about free reserve includes share security premium as well. Specified security include ESOP, sweat equity, etc. An explanatory statement should give all this detailed reasoning and provisions. You need to convene the board meeting for following resolutions, and finally, closure of the offer need to be done within 50 days and dispatch of the letter and extinguishment of the certificate. If we talk about the difference between, friends, capital reduction and buyback, friends, under the FEMA regulation and under FEMA regulation. Friends, for the capital reduction and buyback, from the perspective of FEMA, is been considered as a transfer of share from non-resident to resident. In this case, non-resident is the actual shareholder and resident is the company, because the company is purchasing its own shares by way of capital reduction or buyback. Therefore, three things which has been provided. A, first of all, pricing. Another is reporting requirement. It would be treated as a transfer of share from resident to non-resident. Sorry, non-resident to resident. Resident being a company being a resident is purchasing the share from the resident shareholder. Non-resident shareholder. Pricing for a listed company, the price work out in accordance with the relevant SEBI guidelines, typically the preferential allotment guidelines. And for pricing for an unlisted company, the valuation of the equity shares to be done as per the international acceptable practice methodology. Valuation carried out by on arm's length basis by a chartered accountant or merchant maker registered with SEBI or CMA. They are purchasing company cannot pay more than the fair market value arrived by chartered accountant or the category 1 merchant maker for an unlisted company. If the value of the company is coming, because it would be treated as a transfer of share from non-resident to resident, and resident cannot pay more than the fair market value. Once you comply with the pricing guidelines, Form FCTRS shall be filed within 60 days of the transfer of equity instrument or receipt or remittance of fund, whichever is earlier, through firm portal, and onus of reporting shall be on the resident transfer or transferee or the person resident outside India holding equity instrument on the non-debatable basis. These are the overall provision with respect to FEMA you have to keep in mind while we are dealing with the capital reduction or buyback. Friends, high level comparison, if I see attribute, buyback and capital reduction. For the buyback of share, approval required, board approval, shareholder approval. For capital reduction, shareholder approval, creditor consent and approval of the NCLT. Limit of repatriation amount. This is important, friends. For capital reduction, there is no limit. For buyback, since it is always we say restricted buyback, is maximum amount 10% of the paid up capital and free reserve to be approved by the board. If approved by the board, if it is by shareholder, then up to 25% of the paid up capital and free reserve, and maximum number of equity shares which can be bought out is 25%. Assuming, let's take an example, your paid up capital is 150, your reserves are 50. That means 200 rupees is the sources of fund available for the purpose of reputation. You have a paid up equity capital of 100. You can maximum buy back 25 shares. For the purpose of purchase of 25% share, that is 25 in number as per this example, you cannot pay more than 50 rupees as a maximum amount for the purpose of resorting buyback of 25%. 25% is the number of equity shares, whereas the amount or the consideration for buyback would be 25% of the net worth of the company, which include paid up capital and free reserve as per last audited balance sheet and to be approved by the shareholders of the company. Net worth, positive net worth required to buyback on which above limit will apply, but for capital reduction, there is no necessity or requirement of having a positive net worth. Notice to the creditor for buyback not required. It is a board and shareholder decision, right? But for capital reduction, it is required and seek their observation also. Valuation in case of a non-resident member, valuation report is must, maximum price not exceeding the accepted, which we have already discussed. And for the purpose of capital reduction, of course, from FEMA perspective, definitely required exclusively. Timeline for buyback generally can be completed within a 2 to 3 month period of time if it is a listed company. If it is not, then within a 1.5 month period of time. Buyback shall be completed within a period of 1 year from the date. Should be completed. Overall timeline provided under the Companies Act is buyback shall be completed within a period of 1 year from the date of passing of board or shareholder approval, as the case may be. But for a capital reduction, 7 to 8 months is tentatively dependent on the NCLT and could exceed considering the restriction imposed by NCLT due to COVID pandemic situation at present. Restriction on repatriation, buyback shall not be made out of the fund borrowed from the bank or financial institution or from proceeds of any earlier issue of the same kind of shares and security. No restriction as such is there for the capital reduction. One point also you have to keep in mind, friends, when we are talking about 25% limit of the buyback, that applies to only and only equity share. I deliberately said so. If it is a preference share, then you can go up to 25% of the buyback. Sorry, up to 100% of the buyback of a preference shares. But funding should not exceed more than, sources of funds should be is restricted 25% of the net worth of the company. At equity ratio, for a capital reduction, there is no such requirement, but for buyback, of course, 2:1, post buyback. Restriction on period, no offer of buyback up to 1 year from the date of the closure of the preceding buyback. And for capital reduction, you can resort any capital reduction scheme as long as NCLT is approving it. No objection, no problem at all. Tax implication, buyback is having a tax implication of 22%. For capital reduction, dividend capital gain tax would depend upon the Indian foreign company treaty, etc. These are the board principles you have to keep in mind while we are talking about buyback of share and capital reduction. This is just a comparison I thought to share with you, which may be of use. Friends, let's come to discuss about case studies. Capital reduction, apart from which is a general, simple, straightforward case, can be resorted by way of following the section 66, section 68, erstwhile 77A and section 100. This can be achieved through NCLT process by way of compromise and arrangement. What has been done in the Macmillan Publisher Limited? Macmillan Publisher Services is a publishing house company. In the year 2008, then followed by in 2012, schemes have been floating. Whereas exit to the minority shareholder has been given. The company has decided to look, these are the, whosoever the public shareholder is there, they are more than welcome to offer under the scheme of compromise their shares to the company at a pre-decided value. Valuation is done by a chartered accountant. And this is a value X price we are offering you in case somebody would like to tender their share. Company is ready to purchase under the scheme and they can be paid cash by the company under the scheme of compromise arrangement undertaking place between the company and shareholder. In the scheme 1 we have done in 2008 successfully, substantial majority of the public shareholder has come and tendered their share and they get the money because the shares of the company was illiquid. Another scheme has been designed in 2012. Whosoever the leftover shareholder were there from the previous one, again they have given 3 offers. A, they can again come to the company, tender their share, company will purchase the share and pay them the cash, and accordingly capital reduction would be treated as capital reduction or akin to buyback. Another offer has also been floated. Whosoever the equity shareholder has been there, they can get the preference share in the company, convert their equity into the preference, and the value for conversion would be the value of cash exit which we are providing, assuming 69 rupees was the per value share, on which offer has been made to sell the share to the company under the buyback / capital restriction. However, in case somebody is not interested, then the offer has been given for them to convert that 69 rupees worth of or equivalent worth of shares, equity share, can be converted into the redeemable preference shares. Thereby, we have converted equity shares into the preference share, which quite recently, day before yesterday also, one of the Mumbai NCLT bench member has again approved it. By this, what we have done, not only given them the preference share, converted the equity into the preference share. That means equity to that extent had been reduced, cancellation or capital reduction taken place. Replace this with the preference share, and also another thing has also been done. Because the company was a public limited company intend to go for to become the private limited company so that they should not have any problem from the public shareholder per se. We have converted that companies, even the preference share and equity share, into a trust, so that one of the trustee of equity shareholder, one of the trustee of the preference shareholder would act as a member, and the companies, in the company books of account, it should be non-resident shareholders, assuming 1 or 2, and 2 equity trustee of the equity shares, shares trust, and trust one of the trustee of the preference share trust would become the member. Thereby, private limited company status has also been achieved and successfully implemented through. Similar kind of scenario has been done by the unique of Arisen Technology Smart Plate sector, when the matter has been gone to the Honorable High Court, in the state of Karnataka and the Karnataka, they have also done that. The non-resident shareholder would continue to will become the shareholders, will subscribe to the CCD, convert the CCD into equity, and the existing shareholders of the company under the scheme under the scheme of compromise and arrangement, they will convert their equity share into the redeemable preference shares, and the redemption would take place. Thereby, adjustment of the equity share capital by way of reduction into the capital, converting them into the preference and redeeming thereafter. Once 3 months down the line, 6 months down the line, preference shares has been redeemed, the foreign foreign CCD holder convert the CCD into the equity, thereby achieving the 100% equity right on account of conversion of CCD into equity, and by then existing equity shareholder of the company has already converted into preference and got out of the system. This is how the scheme of compromise and arrangement can be achieved. One of the cases which happened in the Megatex also, they were having a substantial huge losses. Their company, on account of the losses, net worth has eroded. This company has become, in 1 year, it becomes the potential sick company. In the subsequent years, it became the sick company. And there was no reason they will able to go out of the clutches of the BIFR. What we have done, we have converted from the retrospective effect, enter into a scheme of compromise and arrangement, and said that whatever the loss of the company is there, that would be adjusted, that shall be adjusted against the profits of the company and paid up capital of the company. And we achieved the positive net worth retrospectively. So that, say, assuming in 2013 and 14, the company balance sheets in 2013, it became potential. 2014, it became sick. In 2016, what we have done, retrospectively, by fixing the appointed date as at 1st April 2013, adjusted the entire losses against the paid up capital of the company and created a positive net worth, and accordingly reported to the BIFR. Yes, for a limited period of time it was a situation, but now retrospectively the positive net worth has been created through a High Court order, and matter has been achieved by way of reduction in capital, adjusting to the losses by way of invocation of Section 100 under the scheme of compromise arrangement, then prevailing 391 to 394. Very interesting scheme has been done for Continental Tire Limited, sir. So far you would have understood and read the capital reduction is possible only for the accumulated losses, not for the business losses. Assuming we have a loss of 100 crores, we have a paid up capital of 150 crore or slightly more than, say, more than 100 crores. We go to the authority based on the latest audited balance sheet. We say this loss, not representing the true value of the asset of the company, is getting adjusted against the paid up capital. Minus that out, balance sheet, say, assuming 101 crore is the paid up capital, 100 crore is the loss, adjusting the 100 crore loss with the 101 crore of the paid up capital, residual would be 1 crore only. Positive net worth has been created, loss has been adjusted. What we have done, we have entered into a scheme of compromise and arrangement. Though the previous example can very well be achieved through a simple scheme of capital reduction duly approved by the bench of NCLT now and erstwhile High Court. What differentiator we have created is from the perspective of how do we achieve, because we were expecting this company is going to have continuous losses in 5-year period of time. Though the example which I have given retrospectively, we can adjust the losses of the current year with the current financial statement through capital reduction. But what about future losses which is bound to come as per our projection? And are we going to again and again to the NCLT or the High Court, as the case may be, for having a capital reduction or second on case to case or on year to year basis? No, friends. What we have done, we have entered into a scheme of compromise and arrangement involving capital reduction. We have projected the losses for the next 5 years and profit for the next 5 years with a condition and rider. In future, we are going to create a business reconstruction reserve each and every year. Profit of the company would be transferred into the company would bring the share capital with the premium. Premium would be transferred to the share capital reserve, business reconstruction reserve. At the end of the year, if the losses are there, those losses would be adjusted from the business reconstruction reserve, and if any leftover portion would be there in the business reconstruction reserve, that would again be transferred to the share premium account. For next 5 years, we estimated close to 5,000 crores of the losses. With the undertaking and guarantee, the promoter of the company will be bringing the money cash by way of premium, heavy premium. Premium first would be transferred to the capital restriction, business reconstruction reserve. Loss would be adjusted then against the business reconstruction. Leftover would be brought out back to the preference. So that rather than going on year by year to the NCLT, prospective 5-year approval has also been set in under the scheme of compromise and arrangement. It's very live example of a Ricoh India, this photocopier company, Japanese state company. This company had a serious fraud by their management of the company. Company's shareholder, because it was a listed company, shareholders' losses, shareholders' worth has been eroded to the extent of 1,000 crores. Media reported, sir, very live case during those days, friends. Talk of the city, every corner and look. What they had done based on the advice given by some consultant lawyers, I would say like lawyers, they were approached to the NCLT by way of bringing cash to the company, by way of allotting the shares to the promoter of the company, right? And they've just filed an intimation to the stock exchange. This capital reduction scheme has been there. They will bring the cash, and accordingly, the net worth of the company would be restored by way of bringing cash at a premium. But though they have filed the case before the NCLT, intimated to the stock exchange, but they have not sought formal approval from the stock exchange. Stock exchange in 30 days didn't respond. They proceeded with the matter. Practically, I'm sharing with you, ideal situation would have been they would have resorted to have a confirmation or NOC, confirmation or ROC from the stock exchange. Only they were supposed to file it. In terms of Regulation 11, as you would have read, before any scheme of compromise and arrangement need to be filed for SEBI stock exchange for seeking their no objection. They have not taken any no objection. They filed the scheme. NCLT bench of Maharashtra, Mumbai has approved the sanctioned the scheme. The moment the order comes, SEBI and the stock exchange has waked up, filed an appeal before the NCLT, stating that, you guys, reduction of share capital first provision has not been invoked now, even at this stage. Those have been not made effective. Even if this would have been made effective, situation would have been, they have not taken our approval. Regulation 11 clearly says they need to first approach us. Once we sanction, then they approach to NCLT. Since they have not taken our approval, therefore scheme cannot be resorted. And friends, till now, the shares of the company, to that extent, capital reduction has not been made effective by the direction issued by authorities, that is SEBI and the stock exchange. It was registered in the Bombay Stock Exchange only. These were the few cases I believe I thought to share with you, friends. With this, I hand over to the organizing team of ICSI for further discussion or any deliberation or any question you have in mind.
Yes, sir. You have 20 to 30 questions. So I will take one by one, sir. Can a defunct company opt for reduction of share capital?
Yeah.
So what is your opinion if it is said that majority prevails in reduction of capital?
Fundamental point is that there are always an issue whenever we are talking about a capital reduction from the perspective of invocation of section 66 only. Then majority definitely resolution is required. In that scenario, we say that majority prevail. But when it comes to the capital reduction through scheme of compromise arrangement by following section 230 and 231, then the decision of the NCLT would be final. In that case, it is not necessary the majority shall prevail.
Up to what extent the face value of share can be reduced by a company?
See, as long as it is well within the face value of the shares, whatever has been defined, because in Companies Act, there is no restriction to what should be the minimum face value. It can be 1 rupee also, 9 rupees also, 5 rupees also, 10 paisa, etc., etc. Therefore, even if there is no restriction per se, assuming the paid up share, face value of the share is set 10, and there is 9 is unrepresented value, loss, adjust the loss, keep it, bring it to the rupee 1 level 1. But it has to be some paisa or rupee has to be there.
is, if the company has issued different classes of share, can it reduce its capital from a particular class of shares?
This is a very tricky situation. If you go by the Class A, Class B, Class B share, there are two types of share: equity and preference. In preference, also different kind of articles are there: cumulative, non-cumulative, or I would say different 9%, 10%, 5%, 6%, 7%. In my view, even if it is an equity of a different class, you can resort this debt, but this is something which is generally not been resorted, would definitely be of dispute. But in my view, if they're talking about equity and preference, in equity also we have Class 1, Class B, Class C, etc. We can carry out that. As long as the overall contour of 25% of the equity share overall paid up and 25% of the net worth paid up capital is been resorted, should not have any problem, but definitely eyebrows would be raised by the authorities.
So whether fresh issue of equity shares at premium can be used to redeem preference shares?
Same kind. The restriction is same kind. Utilization of the same kind of issue of shares should not be there. Equity can be used, as I already clarified. Equity proceed for preference, preference for equity.
Whether the promoter can opt out at inception from the capital reduction scheme.
In a scheme compromise and arrangement, it is possible. For a listed, it is not. For unlisted, it is.
Are the day-to-day vendors, suppliers to be considered as the creditors?
Yeah, generally, whenever we are going for an NCLT do not bring any kind of dispensation. They have used the word creditors, secured and unsecured. Generally, if you are able to convince the bench member, these are trade creditors, may or may not be existing on a particular date. Therefore, if it can be carved out, in more than thousands of cases during the High Court days, it was possible to take. It was a number of ways we also have done is High Court was considering those kind of people as not as a creditor, they were treating as a trade creditor, which would be paid off in due course period of time. Generally, they were considering secured and unsecured supplier, etc. But these kind of people. But considering the NCLT scenario and the practical difficulty practice we are seeing, they are going word by word, not going interpretation beyond what has been written. Therefore, difficult to take this position under the current scenario convert environment. You look, vendors and those suppliers cannot be considered. These are the creditors. They owe the money. Except certain time we have seen there are judgments, thousands of judgments for an employee. Employed user cannot be considered as a creditor. Because the intention is not there to lend and bring business. It was a contract of employment rather than contract for employment.
Next to this question is, who will ensure that the interest of creditors and policyholder are safeguarded?
It is a protection. That is why if you go for, see, for under the buyback under section 66 capital reduction, it is the director of the company has the responsibility, indirect or a hidden responsibility. When it comes to the list, when it comes to the scheme of compromise and arrangement or NCLT process need to be followed, they are giving a public notice also after that. And any stakeholder can approach an authority, they can approach, though they say ROC, RD, official liquidator. That is why this respective agency virtually has been made responsible directly or indirectly to take care of the interest of the stakeholders.
The next question is, when the tribunal gives notice of application made by the company to central government, SEBI, ROC and creditors of the company, how much time is allowed to them to respond?
3 months.
Already been covered. What happens if no response is received from them within the prescribed time?
You're talking about a practical scenario. Practically, depending upon the honorable judge who is sitting on the chair, both the members, technical and judicial. Practically, we have seen even if the 3-month period they didn't respond, or either of them not, they generally give another 2-week, 3-week, 4-week period. There are two scenarios. Their attorney or their representative is appearing, and they say they need more time. Generally, at least one extension I have seen practically, honorable bench member is ready to give with reasons, etc. If it is going beyond 1 or 2, then definitely they can override and they can proceed. If the judge is strong enough, he'll also say, okay, a 3-month period has been granted, and I'm not giving any extra time. So considering you have not responded, that means you don't have any observation. I'm sanctioning the scheme. Depending, there is no legal answer. It depends upon the judgment of the judge who would like to take, whether he want to be more relaxed And more relaxed is also a relative term. Relaxed to me, that is a petitioner, or relaxed to the public at large of the organization. This is what need to be keep in mind. I, being a lawyer, will pursue the post. Enough time has been given. My entire process has come to the standstill. Why are you giving this with the not responding? But they are most of the time considerate. Give another round, another share. Okay, give another 1 month period of time. Let them respond in 2 week, 3 week, 4 week period of time. After that, I'll pass out. Sometimes it will be practical difficulty also.
Can reduction of share capital be part of a scheme of amalgamation or fast-track merger between 2 or more companies so that...
See, the point is that for a compromise and arrangement section 230-30B, definitely it can be. We have done more than 1,000 schemes. But for a fast-track merger, the provision is only between the holding and subsidiary. Only merger amalgamation, no compromise and arrangement scheme versus being used for 233. Therefore, in my view, capital reduction or such kind of arrangement would not be possible, cannot be resorted in a fast-track merger, because the name indicates merger and demerger is only merger amalgamation is being there. Even the word demerger is not being used. People raise issue and the authorities and the RDs are taking your demerger is not part of this. They're talking about merger. So practically we see in a broader level, in a loose language, we say merger include demerger. Because in one side it is demerging, another it is merging. But it is a 50-50 scenario or one scenario, not in holistic way. Therefore, in my considered view, to 233, the fast-track merger is not possible for a capital reduction, but for sure, compromise and arrangement, capital reduction can be done through same scheme under 230-231.
What parameters are considered by the tribunal while approving the scheme of reduction of capital?
No, I didn't get your first part.
What parameters are considered by the tribunal by approving
the point is that tribunal, while they are considering, generally they are sitting just like an umpire. Apart from that, if any public objections is there, then they consider 90% or 95% whether the process and procedure duly provided and dictated in the statute book has been followed or not. If some objection comes from any statutory authority, definitely they will consider into keep in mind. Their duty is to check 80% process procedure, check the box SOPs has been followed or not, and then if any objection, if anybody has any concern, then only they will say. If nobody has raised the question, they are not going to say there could be a better way of doing it, you could have done in this way, that way. That is altogether out of their views and purpose. They can raise question, but definitely it is you who has to settle and accordingly settle it down.
So the next question is whether the scheme of reduction can facilitate both reduction of share against losses and payments to shareholders.
Yeah. Can be. I told you, if you see the section in reduction in any manner, read that word, remember that word.
So the next question is for making a company wholly owned subsidiary of its majority shareholders, like 99%, whether to file application under subsection 11 of section 230 or section 66.
233, 231, 230, sorry.
230 subsection. Next question is, can reduction of preference share and redemption can be done in a scheme of reduction?
Can be done. I told you each and every time. Section 230 to 231 is talking about compromise and arrangement, which is way far from 66, 68. But for 68, the condition provided under buyback need to be necessarily complied. For 66, there is no restriction. Therefore, 232 have a wider coverage.
The next question is, if subscription amount is received under FDI, then prior permission of RBI is required before NCLT approval or post NCLT approval?
Sorry, I didn't get the question. Can you repeat?
If subscription amount is received under FDI, then prior permission of RBI or any bank is required before NCLT approval or post NCLT approval?
Post NCLT. As a matter of process, when the NCLT is giving notice to the central government register of company RD, at that point of time they need to give to the RBI as well, and RBI accordingly provide their comments, and accordingly the NCLT need to act upon.
Do we need to apply for reduction of share capital before filing application for striking of the company?
No, not required.
whether conversion of fully convertible preference shares, say with a face value of rupees 1000 each, into one equity share of rupees 10 each fully paid up will result in reduction of share capital?
No. Section 55 clearly say conversion of preference or redemption of preference. Conversion is equivalent to the redemption, right? You're redeeming that preference shareholder part and converting the security. Redemption and same principle of redemption will apply to conversion. When redemption says if the redemption is been there, then it shall not be treated as a reduction.
Can you elaborate on selective capital reduction?
Selective capital reduction is you are giving some like generally what we do in a scheme of compromise and arrangement or in a capital reduction scheme. We say that we are actually forming a scheme for the purpose of all the shareholder or particular set of shareholder, assuming whosoever the shareholder holding in it for a listed company under the scheme of compromise, we are saying, look, whosoever is holding the shares of overall value of less than 5,000 rupees, they can tender their shares. That means selective set of people we are resorting, that is possible.
Suspendency of proceedings in tribunal for few years can be ground for ordering fresh valuation of shares.
Pardon, I didn't get you. I missed you in the beginning.
Yeah, suspendency of proceedings in tribunal for few years can be a ground for ordering valuation of shares.
Yeah, it can be. They need to see the latest position of the financial. Generally, not more than 6 months. Practically, they can say up to 1 year. But generally, we have seen definitely that's required that warrant new valuation, fresh valuation.
The next question is withdrawal of capital reduction application is permissible after the company has issued notice to ROC, RD and publication of notice in newspaper and before next day of hearing.
Yeah, it can be. Simply say you withdraw the application and accordingly give another notice stating that, look, no more in existing, board has decided to take away, shareholder has decided to withdraw the decision, we are withdrawing the application. So always keep in mind, all this kind of scheme, once approved by the NCLT, you need to file an order within 30 days to the ROC. If you are not filing the order to the ROC, chapter is over. If you are filing extension, then it's okay. Even if you want to withdraw, you can withdraw that order.
The next question is when shares are transferred under subsection 6 of section 124 of the Companies Act 2013 to IPF authority, what is the mechanism for payment of the amount to the shareholder in case of reduction of capital?
No, see, definitely whatever the reduction scheme etc. has been there, that order shall be given to the IEPF, Investor Education Protection Fund Authority, and they also need to act accordance with the sanction given by or provided by the NCLT. Whatever the capital reduction amount is, that portion, that part you need to transfer to IPF and in future, shareholder can claim those things from the IPF account.
The next question is how can a company reduce its share capital if does not have enough cash resources to pay off to shareholders?
So this is one of the manner of giving. In case company don't have any cash, where the question of payment to the shareholder comes, isn't it?
Next question is whether the buyback tax would be recognized as for computing the 10% or 20% threshold?
Yeah, it would. No. Tax is on the after post cash money. Yeah? It is over and above the consideration. If 100 rupees is the value, 10 rupees, 10%, you have to be paid by minusing 10. Income में generate माना जाएगा ना आपके.
So the next question is whether valuation report will also be required in case if buyback is there only for resident shareholders.
No, there is none. There is not required. There is no such requirement. From regulatory perspective, there is none. Accounting statement treatment is to be there. Valuation is not mandatory. But definitely when they are giving the solvency certificate, shareholder security, ideally it should be done. Ideally, valuation should be done. Because income tax authority is also going to ask.
Suppose there was capital reduction to set of losses. Value of share were reduced to rupees 10 from 100. Now what would be the face value of authorized capital, rupees 10 or 100?
So that depends
In
upon
capital
if both
process of-
options are available. You can reduce the value of the shares of face value of the share from 100 to 10, or you can say 100 will continue, but it will actually represent 10 only. Because assets are not underlying asset, but ideal way would be reduce the face value of the company from 100 to 10.
In case if there is an arbitration award for payment of amount to shareholder followed with cancellation of share, which is also approved by High Court, will process of NCLT be required?
No, if High Court approval is there, then in a separate section, you can, I am forgetting that particular section, if the High Court has approved it, you can go forward for that.
So the next question is, sir, would it be possible to convert the reserves to preference capital and redeem?
No, out of the reserve you can issue the shares and thereafter you can convert. You can definitely do that.
Whether the capital reduction scheme is required to be published on the website of the company?
Yes, for a listed company it is must.
On what circumstances valuation report is required for a scheme under reduction of capital?
No, valuation I told you for a listed company it is mandatory while you are resorting the FEMA compliances. For a unlisted, for a pure resident company it is not, but practically we advise to go for a valuation.
In this case, who will issue the valuation certificate, sir?
It can be done by a chartered accountant or the registered valuer. Or particularly I would say a chartered accountant who is a registered valuer who is a chartered accountant ideally. If it is a non-resident shareholder. If it is not, then definitely you should go for a registered value and panel in terms of the ROC or a Companies Act requirement.
So the next question is it necessary that all annexure to the application or petition should be printed on legal paper?
No, it is not.
So sir, last question is, who need to sign the declaration in respect of the outstanding deposits?
The managing director, two directors including one managing director.
Sir, you have well covered all the legal aspects of reduction of share capital and buyback of shares with the case laws. Before we conclude, I would like to mention once again that the nomination for ICSI National Awards for Excellence in Corporate Governance are open till 6th of October 2021. Let's again have look on the video.
The Institute of Companies Secretaries of India invites nomination for the ICSI National Awards for Excellence in Corporate Governance 2021. The ICSI National Awards are one of the most prestigious awards in the country that recognizes and promotes the culture of good corporate governance.
This year, the Institute rolls out the 21st edition of the ICSI National Awards for Excellence in Corporate Governance.
6th ICSI CSR Excellence Awards, 3rd ICSI Best Secretarial Audit Report Award and 1st ICSI Best PCS Firm Award.
Applications for nominations open. Apply now. Last date of application 6th October 2021.
Now I propose vote of thanks to the learned faculty for enriching us with his knowledge on the subject. So thank you, sir. And as a token of appreciation on behalf of ICSI, we present the Shahid Ki Beti certificate. Shahid Ki Beti certificate is an initiative of the Institute to foster the education of girl child of Martyrs, the first certificate was presented to our Honorable Prime Minister Shri Narendra Modi at the Golden Jubilee Foundation Day on October 4, 2017. So this is for you, sir. This year also, ICSI is going to 63rd Foundation Day in the august presence of Srimati Nirmala Sitharaman, Honorable Minister of Finance and Corporate Affairs on 4th October 2021. So thank you, sir, and thank you all the participants.